Greetings, everyone. I'm Melina Tolbert, founder of MJ Tolbert Tax Firm. I'm a certified tax coach, and I'm also a licensed commercial realtor with Coldwell Banker Commercial. So, if you need any commercial real estate, now you know who to call if you didn't know. This year marks 13 years I've been in the tax industry. Wow, it doesn't seem like it's been that long. When you're really passionate about what you do, time flies. And time has really flown by. I won't go into much detail about myself because we have a lot to cover today in a very short period of time. I know some of you are on your lunch break and you have to get back to work. So, if you want any background information on myself, you can visit our new website at www.ataxcoach.com. How does the new tax laws affect you? Boy, we've had a lot of changes since December 22nd of 2017, which is when the most sweeping tax legislation since the tax reform of 1986 was signed into law. The combined impact of these changes will ultimately determine whether you see reduced taxes. It'll also dictate which tax strategies will make sense for you this year. My goal today is to familiarize you with the most consequential changes under the Tax Cuts and Jobs Act and other key tax provisions that I think you should be aware of, and also to help you make the most of the tax savings opportunities that'll be available to you. So let's get started. As you can see, there's a lot of ground to cover, so please keep your questions limited. Type any questions you have in the comment box, and if I don't get to it throughout the video, we'll have a live Q&A at the end of the webinar, so I'll make sure I get to your questions then. The Tax Cuts and Jobs Act reduces the rates for all income tax brackets except the 35% and the 10%. These brackets will be adjusted annually, of course, for inflation through 2025, unless, however, Congress acts to make the new rates permanent. Here's a closer look at the 2018 regular income tax bracket for individuals. As you can see, it starts at 10%, goes to 12, 22, 24, 32, 35, and 37. By law, any refunds on returns that has the earned income tax credit and the child tax credit will be delayed. And unless Congress changes the law, this will be this way every tax season. The states are also delaying refunds this year for identity theft reasons. For 2018, the healthcare penalty of $695 still applies. Now, unless you qualify for an exemption, if you didn't have insurance all or part of the year, you would need to pay that penalty. With the new law, the Affordable Care Act required individuals who were not covered by a health plan that provided at least minimum essential coverage to pay a penalty with their federal return. But starting in 2019, that penalty goes away. Yay! I know some of my clients are going to be very happy because that penalty affected quite a few of my clients. So that's good news to a lot of individuals that just couldn't afford the health care coverage. Some people are having a hard time paying Georgia Power, and $695 a year for healthcare penalty can really put a dent into someone's tax refund. Form 1040 has been redesigned this year, and along with that, we also have 6 new schedules that I'll be discussing with you all today. This is page 1 of the new 1040. It's been redesigned. This is page 2 of the new 1040. It's been redesigned to only include the 5 most common types of income federal withholding, earned income tax credit, additional child tax credit, and the education credit. All other types of income, adjustments to incomes, non-refundable and refundable credits, other payments, and other taxes that existed on the prior Form 1040 has been moved to one of the 6 new schedules, which I'll be discussing with you next. I also want you to note that Forms 1040A and 1040EZ has been eliminated. So starting this tax season, there's only one form to complete your individual tax return, and that's this shorter version of the 1040. This is Schedule 1 of the 6 schedules that I just mentioned. Schedule 1 is for additional income and adjustments to income. If you have additional income such as capital gains, gambling winnings, unemployment compensation, or if you have deductions such as student loan interest, self-employment tax, and the educator expenses, this is the form to complete. Schedule 2 of the 6 schedules is for tax. If you owe AMT tax, alternative minimum tax, or if you need to make an excess advance premium tax credit repayment, this is the schedule that you would use. Schedule 3 of the 6 schedules is for the non-refundable credits, such as the education credit, the child independent care expenses, and etc. This is Schedule 4 of the 6 schedules. Schedule 4 is for other taxes, such as self-employment tax, household employment taxes, additional taxes on IRAs, and etc. Schedule 5 of the 6th schedule is for other payments and refundable credits. If you have other payments such as extension payments, this is the form that you would use. Now, I want to be sure that everyone is aware that when you file an extension, you're filing an extension to file your tax return. You're not filing an extension to pay. So make sure you keep that in mind. Even though you file an extension at the end of tax season, that is not an extension to pay. It's only an extension to file. Schedule 6 is the last schedule of the new 6 schedules, and it is for individuals with a foreign address or third-party designee other than the person that prepared your taxes. Okay. Enough of the Form 1040. Let's get into some of the other tax changes. Let's get into some of the dramatic changes. Besides generally reducing tax rates, the Tax Cuts and Jobs Act has made dramatic changes to the personal exemptions and the standard deduction. For the 2018 tax year, taxpayers could claim a personal exemption of $4,150 each for themselves, their spouses, and any dependents. But for 2018 through 2025, unfortunately, the Tax Cuts and Jobs Act suspends personal exemptions. Yes, there is no longer any personal exemptions. You heard that right. But increases to the child tax credit could offset this for some taxpayers. I'll discuss changes to the child tax credit later in the webinar. Changes to the standard deduction could also help some taxpayers make up for the loss of the personal exemptions, but it might not help a lot of taxpayers who typically itemize their deductions. The Tax Cuts and Jobs Act nearly doubles the standard deduction for 2018 to $12,000 for singles and separate filers, $18,000 for head of households, and $24,000 for joint filers. These amounts will be indexed for inflation through 2025, and after that, they're scheduled to drop back to the amounts under the pre-Tax Cuts and Jobs Act law. Now, the additional standard deduction for the elderly and the blind still applies, unchanged. I also want you to keep in mind that while these changes are only temporary under the Tax Cuts and Jobs Act, Congress may take additional action to make them permanent. So I'll keep you all posted. For the child tax credit, the child must have a social security number to be eligible. Children with individual tax identification numbers, also known as ITINs, will qualify for the new credit for other dependents. So if your child doesn't have a social security number, you cannot qualify for the child tax credit, but you can qualify for the new credit for other dependents. The child tax credit has increased from $1,000 to $2,000 per qualifying child under 17 years old, and $1,400 of that $2,000 is eligible to be refundable. We have a new credit. It's a $500 non-refundable credit. It's provided for certain qualifying dependents other than qualifying children. Some examples of those are children that are 17, 18, or students, other qualifying dependents, and qualified children under 17 with an I-10, which is what we just discussed. Taxpayers can choose to either itemize certain deductions or take the standard deduction based on your filing status. On the plus side, itemizing deductions when the total would be larger than your standard deduction saves tax. On the minus side, itemizing makes filing a bit more complicated. If you don't have a system in place, it can be a bit challenging to gather all of those receipts. So itemizing can be a bit hectic. Some taxpayers who once benefited from itemizing will now be better off taking the standard deduction. This could also have a significant impact on timing strategies. I have quite a few clients that normally itemize their deductions, so I want to take a moment and take a closer look at the Tax Cuts and Jobs Act's impact on itemized deductions. Specifically, the new law limits or eliminates some itemized deductions that are valuable to many individual taxpayers. First, let's discuss the various deductions related to home ownership. For 2018 through 2025, the Tax Cuts and Jobs Act reduces the mortgage debt limit from $1 million to $750,000 for homes purchased after December 15th of 2017, with some limited exceptions. Now, the limit of $1 million remains for home purchase before that date. I also want you to note that now the home mortgage interest is deductible only on your principal residence. It also effectively limits the home equity interest deduction for 2018 through 2025. Now there's no more home equity interest deduction for up to $100,000 of debt used for any purpose. The home equity loan interest is only deductible if it is for improvements to the principal residence. So make sure you notate that. For 2018 through 2025, the new law eliminates miscellaneous itemized deductions that was subject to the 2% floor. This deduction was for expenses such as certain professional fees, investment expenses, and unreimbursed employee business expenses that was reported on Form 2106. So from now on, be careful how you use your out-of-pocket coins on your job, because unreimbursed employee business expenses is no longer deductible. Now, if you're an employee and you work from home, this includes the home office deduction as well. The home office deduction for employees is no longer deductible. If you're self-employed, you may still be able to deduct home office expenses from your self-employment income. Also, for 2018 through 2025, the Tax Cuts and Jobs Act eliminates the personal casualty and theft loss deduction. However, if the loss was due to an event officially declared a disaster by the president, it's deductible. It's not all bad news for itemized deductions. Before the Tax Cuts and Jobs Act law, if your AGI, also known as adjusted gross income, exceeded the threshold, certain itemized deductions were reduced by 3% of your AGI amount over the threshold. For 2018 through 2025, the Tax Cuts and Jobs Act suspends this reduction. And I also want you to note that payments made in exchange for college athletic seating rights are no longer deductible. One itemized deduction that the Tax Cuts and Jobs Act enhances is temporarily, but hey, it's good. It's the medical expense deduction. Under the new law, if eligible 2017 or 2018 medical expenses exceed 7.5% of your adjusted gross income, or AGI for short, you can deduct the excess amount. The threshold in prior years was 10%, and is scheduled to return back to 10% beginning in 2019. Let's hope that the 7.5% threshold is extended. I'll keep you all posted on that as well. Let's take a closer look at the medical expense deductions. Many types of expenses may be eligible for the medical expense deduction. As you can see on the slide, health insurance premium qualifies, long-term care insurance premiums, medical and dental services, prescription drugs. You can deduct your mileage for medical. For 2018, it's 18 cents per mile driven for healthcare purposes. I also want you to keep in mind that expenses that are reimbursable by insurance or paid through a tax advantage account are not deductible. Alimony. Before 2019, alimony and separate maintenance payments were deductible by the payer spouse and includable in the income by the recipient spouse. After 2018, this is no longer deductible by the payer spouse and not included in the payee spouse's income. So make sure that you notate that 2018 is the last year that you can deduct the alimony expenses. Only members of the armed forces on active duty with military orders and permanent change of station can deduct moving expenses. They can also exclude expense reimbursements. Entertainment expenses for businesses are no longer deductible, and now excess business losses are not allowed. However, the losses can be carried forward and treated as part of your net operating loss carry forward. Now, for the student loan discharge, this is something new. Before the law changed, the exclusion for discharge of student loans only applied to forgiveness contingent on the students working for a certain period of time in certain professions for any of a broad class of employers. The exclusion of cancellation of debt for certain student loans is now expanded to student loans that are discharged on account of death or total and permanent disability of the student are now excluded from gross income. All right, this brings us to the end of our presentation. I'll now open the floor for our Q&A. If you have to log off and have questions that I wasn't able to get to throughout the webinar, my email is melinda.tolbert@mjtax.com. please feel free to email me any questions you may have, or if you want to meet to discuss your tax planning or any tax needs, give us a call to schedule an appointment. Our office number is 706 507 2481. Thank you all so much for joining us on this webinar. And now let's get to the questions.